I think we just have not seen what the future is going to look like 6 months from now. And I think what you guys just discussed right now is it's likely going to be much slower. We're going to have rates that are higher. We're going to have the economy that is slower. You've seen that in earnings. You've seen that in some of the manufacturing numbers. And the slowdown is going to continue, and that's going to compound itself and express itself, manifest itself in earnings growth that's likely to slow down. And, oh, by the way, the Fed is going to pressure multiples. So I think all in, there's still downside risk to this economy, even if we engineer a soft landing. And that's not to mention that if we do actually go into a full-scale recession, that is definitely not being reflected, even with the downdraft that we have today. So it's really challenging right now for investors because, yes, you want to look at some of the oversold technicals on certain stocks and certain indicators and say, well, we're probably due for some sort of a relief rally. But I think what ends up happening is instead of having a relief rally, we have relief moments, but then evaporate just like that because we fret over the next data point and the next event risk. So until we have clarity over where this economy is headed and at what point the Fed is going to stop, I think it's going to continue to be a struggle for investors.
All right. Dan, I know we'll talk about your underweight in technology and growth and innovation, and you still think we need a lot to do on the sentiment side. But what happened to the argument that you would step ahead of or try to get in front of the CPI print on Wednesday?
Yeah, I mean, I think Anastasia sort of alluded to this, but I don't think it makes sense to sort of, move and position portfolios based on sort of one data point. I mean, especially a data point that's a lagging indicator as CPI is. I mean, it's officially a lagging indicator. So I think rather than focus on that, I think what Anastasia was mentioning, I mean, at RBA, we focus on profits, liquidity, and sentiment. And despite all this uncertainty about what's happening this year, the conflict with Russia, Ukraine, we have a high degree of certainty, over the next 6 months, chances are profits are still going to be slowing. Liquidity is still going to be tightening. And unless this correction continues at the pace it has, you're probably going to see these big parts of the market that still have elevated valuations and sentiment. So I think all that together tells you do want to lighten up on risk, but keep in mind that it's not a uniform market. There are opportunities in the market. I think it's just not in the stuff that people care about.
Right. Do you worry right now about missing opportunity, or are we so unanimous in our groupthink right now that we think they can wait?
Right. So, I mean, look, we have the advantage of having a hedge book, and we run pretty net neutral. We're just modestly net short. So we are taking small bets on things that seem really undervalued, or in the case of AT&T, a bit larger of a bet because it seems very stable. But we're taking very small bets of things that look like they're already potentially pricing in a recession, the companies that have very substantial free cash flow yields and are trading at like well below like 2019 levels. But I mean, if you don't have that opportunity to hedge, it might still be a little early. We don't know. But so, yeah, I don't worry too much on missing out, but I am placing, some positions that I think could really outperform in this environment and certainly, hopefully at least act defensively.
Right.